Welcome to this lesson on the Trading Monster Dynamic Support and Resistance Indicator. Today we're breaking down a complete mean reversion trading strategy. Hi, I'm Daniel. In this guide, you'll learn how to identify high probability trades by understanding dynamic zones that adapt to volatility. The main advantage of a mean reversion strategy is its ability to offer high risk to reward trading opportunities. Volatility drives the market. It's often the difference between a strategy succeeding and failing. That's why at Trading Monster, we build indicators that adapt to changing volatility rather than relying on static levels. By adjusting to current market conditions, these tools help traders focus on the opportunities that matter most. This strategy is intended to be used on the 15-minute time frame. On the chart, you'll notice two colored bands, an upper band and a lower band. Within each band, there are two zones, an inner zone and an outer zone. The inner zones are where we focus our trading attention, while the outer zones help define the outer boundaries of the market. We are looking for price to bounce or reverse from these areas. An inner zone at the top acts as resistance, while an inner zone at the bottom acts as support. The indicator automatically draws these zones and adjusts them based on current market volatility. This allows the zones to stay relevant as market conditions change and helps traders identify higher probability reversal setups. In this example, you can see price bouncing from support and reversing from resistance, which are the types of setups we look for when trading the inner zones. For a valid setup, step 1 is simple. Price must reach an inner zone. This identifies a potential mean reversion opportunity. Step 2 is critical. Price must spend time at the zone. We look for 2 to 3 candles to establish a battle between buyers and sellers. Once price has spent time at the level, we wait for a strong breakout candle, also known as the entry candle or trend bar, to confirm the move. For a valid buy signal, price spends time at the lower inner zone, a strong bullish candle forms, and it closes above the inner zone. Conversely, a sell signal requires price to spend time at the upper inner zone before a strong bearish candle closes below the inner zone. A quality breakout candle is noticeably larger than surrounding candles with a strong body and minimal wicks, showing directional conviction. Let's now discuss where to place your stop loss and profit targets for each trade setup. If the entry candle is large, place the stop at its low or high. For smaller candles, use the most recent swing high or low to avoid market noise. Our strategy uses a two-stage profit-taking approach. The first objective is the yellow mean line running through the center. When price reaches the mean line, book 50% of your position and consider moving your stop loss to break even to secure your profits. The ultimate target for a mean reversion trade is the opposite inner zone. One final filter: avoid the first re-entry after an extended breakout. Prolonged time outside the zones indicates a trending market, not mean reversion. By following these structured rules, you can take advantage of the high risk to reward opportunities offered by the Dynamic Support and Resistance Indicator from TradingMonster.ai, and I'll see you in the next lesson.